Well, thanks for joining me today, folks. Today is our official mortgage rate release party, I guess. I just launched our video just a little bit ago. I hope you guys had time to watch it. Don't watch it just yet because today we're going to talk about some things. But here's what I want to start with. I guess it's going to be a little uncomfortable at this point. Instead of giving you my forecast, I guess I'll say this. Why should rates come down any further than where they are today? So, folks, my name is Dan Frio. Hopefully you're here because you watch me every day. Today, I'm going to give you my forecast for the year, and I'm going to put a lot of data into your hands because I want you guys to understand, because I have a lot of followers or realtors and loan officers. Big piece of that is consumers as well. But I want you to understand what makes things up. And like the other day when Trump came out and said, we're going to buy $200 billion in mortgage bonds, that spiked, the markets, and rates dropped for about 20 minutes and things. So I want to walk you through all these and what you really need to know when you're trying to figure out what's going on with those and why. So let's get to today's news, folks. So here's what we want to go over, and I'm going to post this. I'm not going to go over this word by word because that's not me. I just kind of like winging things. So here's what we're going to talk about. We're going to talk about why should the Fed cut rates, and then ultimately, why should rates start coming down? So, folks, I'm not Nostradamus. I've been pretty darn good if you look over the last couple of years and what I predicted when it comes to rates and housing. Pretty good. I usually don't look at the glass half empty. I always look at it half full because my goal is to help you guys understand the markets. If you're in a bad market, you're in a bad market. I don't need to keep telling you every day, but I wanted you to understand the financing. And just so you guys know too, I'm not here FOMOing real estate. I'm here to help assist you if you're looking to buy. And if you're a homeowner now, maybe take advantage of these rates today, or where are they going to go from here? So let's get to what we're going to talk about today. Here's the main things you have to focus in on. I'm going to say you guys because I'm going to leave this up to you guys to determine where you think rates are going to go, because you probably have a 50% chance of being right or wrong. But we're going to go through the data that the Fed watches. And it's the same thing that the markets watch as well. And I know I go through this every day, but here it is. Okay, so they're going to go in over inflation. That's what they monitor. We're going to break that down where we were. I know you think prices still suck now, but where we were and then where we are today and where things are going, especially with energy and things like that. So we're going to pay attention to inflation, and I'm going to give you my outlook for where I think we're going to go, even with tariffs, in this video. The next thing is the unemployment rate. Actually, that came in recently and it shocked the markets. It was on its way up to 5%. Anything under 5% is full employment. It was at 4.6, and everybody's like, okay, that the Fed's cutting because they don't want to get to 5. It actually dropped. It actually went from 4.6 to 4.4. And then GDP, President Trump was just having an announcement. He says the GDP announcement that's coming out should show that our country's growing at over a 5% pace. So if you're looking at the economy, you might say, okay, the economy's growing pretty good. When you're looking at GDP, then you look at inflation, and it's over 2% that the Federal Reserve wants. But I'm going to show you and just give you some thoughts on that, how the PCE works and inflation works to control interest rates. Okay, so let's dive down the path. Let's start first looking at inflation. And all this is going to play a role in what's going to go on with these, and I'm going to explain to you the whys. Okay, so first we have to look at inflation, and that's what the Federal Reserve looks at. So when we look at that, we look at the PCE, that's what the Federal Reserve looks at, but we look also at the CPI. Well, that number actually came in today, ironically, and it actually came down. And if you watch my channel, I've been calling in the last few, I'm like, okay, we track energy probably more than all these other mainstream media channels. And when we focus on energy, especially oil, when it was like $90 a barrel, remember when you used to spend $5 a gallon? Now it's even in Chicago, it's like $2.40. That's good news there. But because of that, you're going to start seeing inflation starting to kind of tap out and start to come down. Now, tariffs are a big role in this. So let's take it apart. Tariffs, what are they going to do? We don't know what they're going to do. But I'm still saying the courts are going to deem them illegal, or parts of them illegal, and that's going to just put some guardrails on things. I think it's going to be good news. How they're going to refund the money and all that, I think they'll work that out, and it'll be okay. So that's what we're seeing on the tariff side of the equation. Then you look at consumer inflation. Okay, the tariffs didn't skyrocket inflation because you just saw consumer inflation today. And folks, I'm just the messenger. I'm giving you the data so you can understand the data. So a lot of people down below, all those numbers are fake and so forth. I can only use the data I'm working with. So if you look at today's numbers, you look at the CPI, and then it might be a little bit hard to read on your screen, especially if you're on a cell phone. But let me try to bring that in. Let's just look at the CPI right through here. It came in at 2.7. Actually, it came in at 2.6 because they're revamping some numbers. But what the media looks at is this number right through here. With the inflation last time came in at 2.6, and everybody said, well, it's going to come in at 2.7. And I came in, check my video last night. I was like, with energy and housing, this is going to start to topple. And I know core strips out energy, but I'm still saying, okay, I think this is going to come in maybe a tick lower. And it did, right on point. Okay, so we called that when we've been calling it lately. Okay, so now when you're looking at consumer inflation, yeah, I know at groceries, it's still everybody says, eggs are $20 a dozen or whatever, but that's watch where you shop. But if you look in general, most of the home food prices have somewhat stagnated. So this is reporting through here. So on the consumer side, looking okay. Tomorrow, I wish we had this news today because tomorrow we're going to get the PPI. So today we got the CPI, which is consumer inflation. Down through here, tomorrow we're going to get the PPI. That's producer inflation. Now the tariffs, if they're going to hit anywhere first, they're going to hit there. Okay, so you're thinking, okay, it's going to hit the producer side first, and then it's going to roll over to the consumer side. And that's where I think a lot of the markets are looking at. So if we're looking at this, it's not even giving us a precursor what it's thinking it's going to estimate in, but they're saying month over month, its last reading was 0.3. What's it going to do this time? I'm not even going to try to read it because the data is starting to uncloud, but it's still a little bit cloudy. So if we look at just the data we have so far on the CPI, it's going pretty good. The PCE that the Federal Reserve monitors, not so bad either. I'm confusing you. Let's get to the next one because inflation, it's not going crazy, folks. Now the jobs market. Well, the Federal Reserve came into last two meetings and specifically were just like, we're going to cut, and the times they cut, we're going to cut because of employment. Or unemployment, I guess, because the Federal Reserve has two mandates. They were created, I think, 1930 something, and they were created for this: keep prices in check, aka inflation, and keep the jobs market in full employment. And anything under 5% is full employment. So they're like, okay, the employment number recently, and this was supposed to be the unclouded number, actually went down from 4.6 to 4.4. Okay, so now it's saying the employment numbers are looking pretty decent, but now inflation's not really moving over there. So the Fed's going to hold, and they're expected to hold the next few meetings. So here's what my thought is where this is going to start to topple. Okay, so let's go down this route. By May, we're going to have a whole new cast of characters at the Federal Reserve. Okay, so it's going to be more Trump appointees. So that's good news for the Fed, so you can get rid of all this cloudiness that we're going through right now. So that's good news for that. In the Trump administration, they have bond gurus, I guess is the best way to put it. And what I liked about it is when they came into office, is I'm like, they know how to kind of manipulate the markets. So they've been moving, the national debt from mortgage bonds to mortgage bills. Huge difference. And then when they did that, I'm sitting there scratching my head. And then all of a sudden, the Federal Reserve comes in and says, okay, we're going to start buying Treasury bills on the excess revenue that we're receiving. So let me put this in perspective, what happened at the last Fed meeting. And this is even what shocked me. Our government lately has been using Treasury bills to fund the government. Okay, what they've done in the past, they use Treasury bonds. Bonds are like long-term things, and bills are short-term. So you have all this debt coming to market. You're thinking, okay, there's billions. So why would you put it on a short-term loan? It's like getting a 2-year mortgage, not knowing where rates are going to go next year or the following year, and thinking this is billions and billions of dollars. I'm thinking, why would they do this and not put it on something like 30 years so they can push all this out? And then all of a sudden they've been doing that. And then all of a sudden the Fed comes out at the last meeting saying, well, we're not going to cut rates, but what we decided to do is use our excess funds to start buying back some Treasury bills. And I was like, oh, that is genius. And all of a sudden, the mortgage rates the next day, after I called it, the next day, the market started to rally on this news. So that's one piece of the puzzle that's coming together. So that's some good news there. The Trump administration came in recently, and let's just now go down the political side of this spectrum. So Trump has made billions and billions and trillions and whatever he has in real estate. Okay, so he's not going to go down as a president that's, crashed real estate. So he is doing everything he can to help the situation the best he can. CNBC says, he just keeps throwing spaghetti against the wall, see if it sticks. Well, eventually something's going to stick. They came out with the 50-year mortgage. That was my 15 minutes of claim. It was all over the news and everything. Don't know how they found me, but that came and went. It still might be a proposal. Then they came out with some other options. Then the other day he came out and said, okay, we're going to buy 200 billion in Treasury bonds. It's kind of like quantitative easing like the Federal Reserve did, but this isn't the Federal Reserve buying, and it's specifically mortgage bonds that's being purchased. So now what's happening is the president is coming in saying, well, Fannie Mae, Freddie Mac, and Ginnie Mae, you have to come in and buy mortgage-backed securities. So what's going to happen with that? It's going to drive up the prices of mortgage bonds. What happens with mortgage bonds go up? Well, the price comes down. So let's do a quick little glimpse of what happened the other day so you can put this into perspective. Now, if you're just a consumer out there watching me, you're probably scratching your head saying, what in the world is this guy talking about? I'll get to it, but you have to just know the fundamentals of all this. So mortgage rates, they're actually created through a mortgage bond that you can see right over here. Okay, this mortgage bond, you see up the top, it says MBS. That means mortgage bond. All you have to understand in this chart is, well, other than what happened in the middle, I'll explain that in a second, is if the price of the bond goes up, rates come down. And if prices of the bond go down, rates go up. Look at what happened the other day. Okay, so if I show you this, you're going to say, my God, think of this as being a stock. Right before the closing bell, this stock just rallied. Okay, so did you have time to get in and do anything? I don't know, whatever. Well, no, because they did it. So President Trump announced that basically the end of the day, or close to the end of the day, that they were going to come in and buy mortgage bonds. It skyrocketed the price of bonds because everybody's like, okay, the government's going to have to buy these things. I'm going to jump in before they buy because they're going to buy no matter what the price is and keep driving up the price. Well, that's what happened. And then people sat there and scratched their head and said, okay, remember the 50-year mortgage and then the transparent mortgage and then the other program? And is this really going to happen? And then what happened is rates went all the way back down and they're worse today than where we were on Thursday. So these are things that you might want to just avoid. So let me just give you a little bit of advice. If you love the guy, hate the guy, whatever, take a lot of the stuff that he takes as just shock and awe. Just let it beat off your back. I know it's hard, but just let it settle in and watch the markets do what they want to do. And then come back 3 or 4 days later, and this is what you normally see. So this is where people that are in the know, they're making a lot of money on this stuff. Don't jump into that. And that's why I even said last year, be calm. The markets were crashing at some point. I'm like, okay, be okay. And it'll be up again. And what happened if you didn't sell out? You did pretty darn well. Okay, so that's what we're seeing in the market. So we take all the fluff out of this. Every once in a while, you're going to have this anomaly that you might have a great opportunity for a mortgage rate. But overall, let's kind of go in a conclusion of this thing. We go down through here. Inflation's at probably the highest peak it's going to be. I'll dig in one more piece of that. You have oil that we track on a daily basis. So if you follow me on a daily basis, we usually come in and I'll be like, okay, here's what's going on with bonds. And then here's what's going on in the stock market. Stock market's getting clobbered today, but it just hit a record high. But we also, every day I come in and say, oh, here's what's going on with oil. And I would say, I love oil when it's under $60 a barrel. Well, it's not right now. And this isn't good. Okay, so here's what happens. Oil's in everything. If you like it, love it, don't, whatever, it is what it is. Okay, oil's in everything. So when oil, the lower it gets, well, the cheaper things are for us, and the cheaper things are going to be causing inflation to come down. Think oil's in gas and half the products that you use. So if oil drops from, it was almost $90 a barrel, a couple of years ago to where it is today, it's good news. Then one last thing here, when it comes to the inflationary numbers, the housing, what they call the rent equivalent housing, it was about 7.7%. Then it dropped to about 5. Then it dropped to about 3. The government is still using a factor of about 3 to 3.5% in the inflation number. It's actually closer to zero. No, why does it matter? Well, it makes up about 40% of the inflation number. So if you're using a number that equates out to 40% of this equation and it's at 3%, but it's really zero, well, what would it do to that factor? So you take oil, you take the housing equivalent rents, you're going to have inflation that's probably going to topple, because with tariffs coming in, I don't really think they're going to come in and say, okay, you can do whatever you want. If they do, I think it's going to be a little scary. I don't even want that. I want them to put guardrails on. No matter what administration's in, there should be guardrails on what they can and can't do. So that's what I'm hoping, and that's most likely the most logical outcome, unless they just come and say, no, you can't do anything, and I don't think they're going to come out and do that. So let's kind of roll all this and make some conclusions. But before we go there, let me know if you guys have any questions that you might want me to just specifically dive into when it comes to these things, because we're also going to talk about some things that might affect housing. And I know we're talking about interest rates today, but foreclosures, that's another area. People are like, okay, foreclosures are going to get crazy. And I'm kind of going to try to debunk that as well. So we have Mike. Mike, thank you for joining me today, folks. So we go over to here, and the markets aren't doing so bad. So let's get to one other piece of the puzzle. And I think I put it through here. Overall, let's just look at where we've been and where we're going. Inflation in January of 23, it was at 6.4. Where we are today, it's 2.7. Okay, so we're in the right direction. Yes, it's not the 2% the Fed wants, but it's going pretty darn good. You go down through here, jobless numbers, it was at 4 in January 2025, and they were like, okay, this is going to 5, and then it kind of petered out, and recently was at 4.6 and now just dropped to 4.4. So we have inflation that's not going crazy. We have an employment market that's not so bad. Let's go to foreclosures. So during the years ending 2023, there's 357,000 people that got foreclosed on. Recently, 101. But if you go back in history, because during some of these times, especially during COVID, please make sure you monitor the data you're reviewing, because during COVID, you couldn't foreclose on anybody. It wasn't allowed. So you had foreclosures almost go to zero. So then when you start even getting 100,000, it seems like a lot, but you have to put it in perspective over the life cycle of housing and everything else. So I hope you get my gist there. Now, the last piece of the puzzle, like I was saying, there's going to be a new cast of characters in the Federal Reserve. They're going to be probably very friendly to the president. He's got a couple more years to do his thing. So I don't think that mortgage rates are going to go up from here. But again, why should they really go any lower? So I hate to disappoint this year, but folks, I'm going to stay in my range of where I thought they would be. You're going to get some instances where, yes, you can get rates in the high fives. So I'm going to say the 30-year fixed on this section here, might be get to 5.875 on the low end. I'm still going to say there could be bumps in the road if tariffs news comes in detrimental, things like that in the short term. These could jump up just a little bit, but I think we've seen the highs for the years. But I'm still saying the high for the year is 6.25. In the low, we're going to see maybe in the high fives at 5.875. Now, make sure you don't disqualify yourself, because there's still a lot of people. I hear Alan in the hallway all day long putting out quotes, and I'm hearing rates in the fives anyways. So let me give some advice to those out there. If you're a homeowner right now, what might you be able to do? Well, we just created RateWatch 2.1 AI. Now, you might get some signals today, some emails and things like that. I've created this system, and what I'm trying to do is get out to the masses, because we have hundreds of people that are triggering right now. Because when rates hit 5.99 the other day, basically everybody triggered. So it kind of blew up our systems. I can't keep up with this personally. So I created an AI system that I monitor daily. So if you get a call or an email or a text from me, Alan, or Tony, I validate it. It's us. If you always want to talk to me, you're more than welcome to talk to me as well. But if you're a homeowner out there, put your mortgage information into that tool up there. It's called RateWatch 2.1 AI. What I want you to do is put in what rate would you like to refinance, or how much money are you looking to save? Let's say you have a $150,000 home and you're like, hey, A $200 savings is fantastic for me. So put in the rate that you want me to call your monitor, and then also put in the savings. It's going to do all that. But you might have, say, Dan, $500 is my minimum. We'll put it in. You have nothing to lose and everything to gain. So now let's say, okay, you're looking to buy in 2026, or you're in the process of building. What should you do? Well, I'm going to go back to basically what I've been saying every day in the last couple months. My goal or my expectations are, I think that a lot of the data is just going to come in benign. I don't think there's anything going to come in that's going to really shock the market. Now, there could always be a text or a comment from who, when, I don't know, but it can happen. So to take advantage of those rates, if you're a homeowner, fill out the RateWatch tool. If you're a home buyer, I don't think you're going to get shocked like those in 2020, 2021, when they went out and they were buying those homes, a lot of homes they couldn't afford, at these rates that they just didn't last. And by the time the house was done, they went from a 3.5% rate to an 8%, and they couldn't qualify. So if you're trying to buy a house right now, use the tools we have down below. I just added another one. I think it's down there. It gives you 3 tools right now. One, if you're a home buyer, how much can you really afford per each mortgage program? So what we're going to do is, my son created these. Get my tip down there, folks. There's been 30, 40, 50 different calculators downloaded, and nobody's even donated a penny. So help him out. But there's calculators down there that's one, how much can you qualify? And it'll even tell you every program that you might qualify for. It's awesome because you might not even know half these products exist. If you're a realtor out there, use it. Loan officer, you probably didn't even know you had some of these programs. Shame on you guys out there. You're a consumer, you got to use it. Another one, should you refinance? Okay, the rates are 607. I'm at 6.875. Does it make sense? It might. It actually might. Check out the calculator we have down below. It'll say the cost of waiting. I think it says lock or float or something like that. Check it out. You might be surprised that waiting for rates to get lower, even within the next year, might not pay off. So check that out. And there's a whole bunch of other tools down there. So now hopefully you understand. I'm not going to do my thing yet, but based on all the data, let's just do a screenshot. What do you think inflation's going to be by the end of the year? Up considerably from here, flat, or down? I'm saying it's going to be flat. The unemployment rate, where's it going to go? Not going to fall off a cliff. And as long as wages keep up with things, I think that's going to be as well good as well. The biggest concern I have in housing is, check out my 2026 housing forecast. And it was posted about 2 weeks ago, and I'll try to put it up through there. Where you're going to see appreciation and where you're going to see some people prosper is where you can afford a house. And I know it might sound stupid, but before you buy, make sure you use some of the tools that we have, especially in that video. We gave you some real estate tax calculators where before you buy a house, go in and see how much real estate taxes are on that house. It might overwhelm you, because when you buy a house, just being not trying to be, I would just want to make sure you're aware of what you're getting into when you could buy a house. It's not only the loan payment you actually have to pay real estate taxes on the home. You have to pay homeowners insurance to insure it. And if you don't put 20% down, you have to pay this thing called like PMI. It's usually maybe $100, $200 a month. So when you add all that up, your payment might be a lot more than you think. So make sure when you're getting into trying to buy that house or build a house, even if you might not be using us, make sure to reach out. Ask any questions that you might have. See if we can get you pre-approved. Don't get pre-qualified. Make sure you get pre-approved. There's a huge difference there. And make sure you just reach out to us. So if you're in the process or want to look at refinancing, make sure you put your information over there, especially if you're over 7%. Just pause the video and call us. If you already have a quote from somebody, upload your loan estimate right up over through there. It's over there somewhere. It says loan estimate review. What we'll do is we'll send you a video. We're going to compare your offer with over 30 different lenders that we use. If you're new to my channel, let me tell you about what we do and what I do and what my slogan is. So my name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. I've been doing this for over 35 years. I work at a bank I've been blessed to, they provide me a license in all 50 states as well as Puerto Rico. The really cool thing and why I'm here and helping build is they're like, okay, what do you guys need to really, really prosper? We're like, we need options. So what they did is they went out and got over 30 credit unions, banks, mortgage lenders. They're like, okay, you can use their rates and their products. So if you want to, check out that and how we can help you with all this and use my 35 years of experience throughout this whole process, click right through here. Schedule an appointment, give us a phone call, reach Dan, ask Dan a question, or even put in your application right over there. So that's it for today. The markets are doing but my overall theme was where I think rates are going to go this year, and the whys, well, maybe you can just answer it yourself. Should rates go much lower? Because is inflation getting in control? It's probably going to stay above 2 for a while. So that's going to halt the Federal Reserve from cutting and from long-term rates getting any lower. The employment numbers, I don't think they're going to fall off a cliff. So the Federal Reserve is going to say, okay, they're looking much better. So don't have to do anything there either. So what would cause mortgage rates to come any lower? That's the question you need to ask. So it's not, hey, when are they going to get to 4%? It's, why should they get to 4%? Because the economy isn't crashing like in the past. How and why rates got to where they did. Check out a video I'm posting this weekend talking about subprime mortgages and how they're a thing of the past. And but be careful of some of the loan programs out there, because you might just get into something you might not be able to afford. So that is our show for today, folks. So hopefully now you know a little bit more of what's going to happen with those this year and why. So pay attention each day, especially if you're a homeowner, especially if you're a realtor or loan officer. Subscribe down over there. So every day I post a video, you get an alert and you figure out what the heck's going on with these, and I'll explain to you basically the whys that are happening, so you can explain it to you and your clients. So thanks for watching, folks. Have a blessed day. And I'll be back here at the opening bell tomorrow to show you how all this mess starts another day. Take care, folks.